So, dear friends, I hope you can hear me. So I'm very glad to see you here. Once again, it's the fourth time, by the way. Some of you had participated in the very first conference, and some probably are online of the first participants. So I'm very glad that it finally happened. Not that I'm slightly mad, but that we met here. And we have quite an ambitious program of 22 presentations from people from 3 continents. And we'll have like 5 or 6 sessions, I don't remember. Each of them we try to organize on geographical basis. It didn't work in all cases, but anyway. So, did I want to say something else? I think not. So, Aurora, he took the burden of organizing all this here, so we have to thank her and the people here for the organizational efforts. And now she's going to explain you some important organizational details.
Okay, thank you so much. Thank you all for being here in Turin. It's a pleasure to welcome you here. And I also wish to bring you the warmest greetings from my association, the Associazione culturale Vera Nocentini, who was really happy to have you as guests for this workshop and you to care for the organization of the workshop. So before starting with the technical details, I thought I might give you some very quick information about this place. Since some of you were asking, this is the Polo del Novecento, and it's a cultural hub which joins together 26 historical associations and organizations working on historical research on the 20th century, and they decided to join together in a single place and join their archives and their libraries. If you wish to have a look then later during some of our breaks or after our tight program, we can do that. So, technical information. We have 25 minutes for each presentation, and you are free to decide how you want to manage this time. You can use the whole time for your presentation, or you can leave a few minutes or more than a few minutes for discussion. You all should have the program. We will have a lunch break at 1:30 p.m. and we can have lunch together here at Polo. We will have 1 hour of lunch break, and then at 5 p.m. We will be free, and we will have a guided tour in historical Turin. You are all welcome to join. The tour will last more or less 1 hour, and then we will have an aperitivo together. So all the presentations will be recorded. Just tell us if you don't wish to upload your presentation on our YouTube channel after the workshop. We will have our slides. The technicians, who I thank, will put on your slides, and you can control them with the remote control. And then just a couple of things about this limb, which I have to activate again. One moment. So, as you know, tomorrow at 2:55, I think, yeah, we have some time for discussion tables. So we thought we might gather all the suggestions for 2 or 3 topics for discussion tables today. So if you frame the QR code there, you can put your inputs, your suggestions for topics. And then tomorrow we can vote for the most interesting topics and organize 2 or 3 tables for discussion. I think I said everything that I wanted to say.
Maybe just a couple of words about these discussion tables. So the idea is, I saw it in one conference, and I like the idea very much. So we divide ourselves in groups, 2 or 3 groups. Then each group discusses some topic together, sitting at one table, and then after that they report the results of their discussion to the whole group, to the main group, so to speak. And it can be very interesting, and sometimes even some cooperations can emerge from this type of discussions. So we really would like you to participate in these discussions, and to both as those who suggest topics and those who discuss them. Thank you.
Okay.
So I think we can start. We have a German session in the beginning, so I think I will stay here maybe and try to keep track of time, and I'll be very discreet. I have even put a sign. Just a second. Yes, I have a sign here. It's for this purpose. So when you see it, then it means that 5 minutes are left. And I'll be very insistent, waving the sign. Maybe I'll sit.
Microphone too. Is it on? Now? Yeah, now it's definitely on. Okay. So, thank you for having me. I'm Kevin Boge, and I'm here to present a paper by my co-authors, Konstantin, Malte Ried, and me, titled The Unequal Impacts of Monetary Policies on Regional Housing Markets. It's not specific rent control, but we do find some definite effects on rents which are quite interesting. As we all know, housing is quite important in any economy. It is actually the main asset or consumption item for most households. Therefore, anything that affects housing will affect a very large number of people, and then the aggregate in any economy. Specifically, we look at monetary policy because housing serves as a primary transmission channel for monetary policy. But the research on monetary policy and housing markets looks often at the aggregate level, but misses some nuances that happen because housing markets are actually very segmented and also very regional. So therefore, we pose the question, does monetary policy have unequal effects on housing markets? And if yes, who is most vulnerable? For that, what we do is we look at the long regional data set on German housing transaction price data. We identify monetary policy shocks through high-frequency identification and combine these to estimate impulse responses via local projections. And we do all this specifically to document these unequal impacts of monetary policies across segments, regions, and policies. Just we find 3 stylized facts. We don't go much into what happens or the mechanisms behind it or the distributional consequences, but we find that land and property prices respond stronger or more persistently than rents. We find that prices and rents are more affected in rural than in urban areas. And we find that the response of prices and rents is stronger to unconventional monetary policy than to general monetary policy. And that is especially driven by a stronger response in urban housing prices. So how do we get to these results? We use, as said, we need very nice data to do this analysis. We use a large panel data set on annual regional housing prices. The main housing prices we use are from the Immobilienverband Deutschland, a panel of experts in Germany on anything related to housing markets. We've got data for over 200 NATS 3-level regions in Germany, which cover, as we will see in a moment, as we can see here, which covers basically all regions of Germany. There are very little regions except the northeast where we don't have some form of data in the region, so we have a good overall coverage. Wrong way. We have prices for ample sample of residential housing types for specifically 7 housing segments, including 2 rent prices, 3 property prices, and 2 land prices. Our data spans 50 years from 1975 to 2021. The indices for each regional price are based on transactional data, which is a great advantage, and we also have a wide range of economic and demographic data to aid a bit our analysis. So we don't want to look at every single region and tell you what happens in Berlin, what happens in Stuttgart, what happens in maybe Halle. We want to see some patterns across different types of regions. Therefore, we determine type of region by their size. Specifically, we use a variable from the Immobilienverband Deutschland, which classifies regions by the size of its biggest city. And this variable gives us 4 categories. Regions where the largest city is mid-small, with a population between 20 and 50,000 people, where the largest city is mid-big, with population between 50 and 100,000, largest city is big-small, 100 to 500,000, then the regions with very, very large cities, which are basically the whole region is just this big city, which is with cities with a population of over 500,000. Importantly, the housing prices we have are for the region, but we classify these regions by the biggest city with also we've seen that it works as a proxy or categorizes, the categories created very well distribute the regions by other socioeconomic variables such as GDP per capita, unemployment, home ownership rate, housing supply. So it's a variable that very well categorizes our regions. So we see here a bit of the data we have. We have the average real housing prices by regions over time. The base year is 2000, and the value 100 is for the base year is only the average one for the whole country, and all other lines are adjusted accordingly. So the black lines are the average for the country, and then for every type of region we've got the different colored lines. As we see here, we've got seven graphs for the 7 housing price segments we have. 2 rent prices, primary market rents and secondary market rents. 3 property prices, owner-occupied flats, terraced houses and single-family houses. And then 2 land prices, single-family plot prices and multifamily plot prices. And what these graphs show you is basically that housing markets are very heterogeneous. We see heterogeneity across segments. So rent prices, really, the evolution of rent prices is very different from the evolution of plot prices, for example, but also across regions. We see that the colored lines are at different level, at different evolutions for each type of segment. So there's definitely some heterogeneity in housing markets. And we want to analyze that. We want to analyze specifically the heterogeneity in response to monetary policy shocks. For that, we need good monetary policy shocks, which we build through higher frequency identification. The idea is that we regress a change in monetary policy rate on meeting days, on a change in our financial market rate on meeting days, and then use the fitted values as an instrument for an exogenous monetary policy shock. Given that our sample is quite long, from 1975 to 2021, a lot of things happen with monetary policy, which we have to take into account. First, Germany, the Monetary Policy Authority was the Bundesbank, which changed, as in many countries in the European Union, to the ECB in 1999. So we take that into account, we use a different policy rate, and then also from 2010 on, there's a start in using unconventional monetary policy, which we also take into account. So for every subsample we create, we estimate our instrument and then put them together into a whole sample instrument. Given that our instrument created is a daily frequency, we have to aggregate it to an annual frequency to match our data on housing prices. And this is how our shock looks. At a daily frequency, at an annual frequency, we see that it does look like an exogenous shock. You may say, is this instrument valid? It's a fair question because we did a bit of constructing together, but we do some tests and all of them yield satisfactory results. We do F-tests to see if the instrument is relevant. It is. We do autocorrelation predictability tests to see if it is exogenous. It is. Then, to my favorite one, we look if our monetary policy shock gives out the expected response in some macroeconomic aggregate variables, and they do. The macroeconomic variables look basically like a textbook response. And then we construct our instrument in various different ways and do a sensitivity analysis, and the results are qualitatively similar and quantitatively quite similar too. So we consider, and I think most people would consider our instrument quite valid, hopefully. So we've got a nice instrument, we got nice data. Let's estimate the effect of one on the other. For that, we use panel-local projections, where on the left-hand side, we've got contemporaneous and future iterations of the dependent variable, and then on the right-hand side, we've got our shock S, where the beta we will use as our impulse response functions, and then we've got a whole bunch of control variables, including lags of the shock, lags of the dependent variable, and lags of other variables at regional and at aggregated level. So what we care about is the beta from the shock and contemporaneous shock to measure its effect on the contemporaneous dependent variable and future dependent variables. And with that, we construct our impulse response functions, which would be these. This basically shows the effect of a monetary policy shock over time, over 8 years, on these different housing prices. Specifically, we calibrate the shock, or we adjust the shock so that it increases of 1 percentage point in the monetary policy rate. So all these responses are to a shock that increases the monetary policy rate by 1 percentage point. As we see, we don't have only seven variables, we have 9, so the 7 housing price segments, and 2 variables at the bottom right which measure exuberance in the housing market, a price-rent ratio and a variable measuring the probability of observing a house price boom. So, first thing we see in all these graphs is that in response to an increase in the monetary policy rate, so a restrictive monetary policy shock, we see a decrease in all housing prices, a significant decrease. So all responses are negative. Secondly, we also see quite some difference across all segments. We see that especially rents respond less strong than property and land prices and less persistently. The effect dissipates after, or starts dissipating after 3 years, while in the other segments the response takes longer. And we also see that the response or that monetary policy is able to curb some exuberance in the housing markets. But as I promised, we don't only look at segments, we also look at regions. What we do there is we estimate these impulse responses for each segment also by type of region. And then take the lowest point of response, the trough response, and compare it across regions from most rural to most urban. And we obtain these graphs. So we see in every single figure, we see that from the left is the lowest point of response of, for example, primary market rents in the most rural region, and then towards the right in the most urban region. And we see again, all trough responses are negative and significant. And then we see a kind of upward slope in all housing prices, in all segments. This basically means that the maximum response to monetary policy is stronger in rural regions than in urban regions. So prices in rural regions are more vulnerable to monetary policy shocks than prices in urban regions. So, to quantify this even a bit clearer, to make it even more clear, we just compare the most rural to the most urban region and have this graph right here. Minus 2.01 being that the response in the most rural region is 2 percentage points higher than the response in the most urban region. What we see here is a specific trend or specific pattern in rent markets where the difference between rural and urban regions is relatively smaller than for all land and property prices, where the difference between the response to rural and rural and urban regions goes up to 13.5%. So not only are renters benefited by a decrease in their home ownership and their housing costs, but they're homogeneously well off in both urban and rural regions, whilst homeowners are in urban regions are affected but not as strong, but especially homeowners in rural regions are very, very negatively affected by a restrictive monetary policy shock. Lastly, what we also look is at the difference between unconventional and general monetary policy. We just wanted to look at this very important policy type in monetary policy over the last 15 years, So what we do is, first of all, we take the response to the overall sample, so from the 1975 to 2021 sample, and then compare it to the response of housing prices to a restricted sample. So after 2010, when our subsample instrument specifically targets to capture the effects of monetary policy. And the response to unconventional monetary policy shocks are the dotted lines. And what we see is that the response to unconventional monetary policy shocks is stronger than the response to a general monetary policy shock. And that is true for all segments, but again, in rents, we see this particular pattern where the difference is smaller, or this divergence between the response to conventional and unconventional monetary policy is smaller. We see that this difference between conventional and unconventional, or conventional and overall response, is especially big in land prices and in the probability of observing house price booms. So unconventional monetary policy is very able to curb exuberance in the housing market. We don't show it here, but we do see that this is especially driven by a stronger response in urban house prices. When we do this same exercise of comparing rural and urban regions, or response in rural and urban regions, we see that the response in rural regions seems to be very similar, but the response in urban regions increases so much that in many cases the response is stronger in urban regions than in rural regions for many house prices. So basically unconventional monetary policy goes more, and specifically more, into urban house prices than into any other prices. So we've shown you what happens when we introduce a monetary policy shock, but are actually monetary policy shocks important drivers of housing prices? For that, we do a forecast error variance decomposition, which shows you the amount of variance of the housing prices explained by variance in monetary policy shocks. The darker shades are for considering an overall monetary policy shock, and unconventional monetary policy shocks variance decomposition are the lighter shaded areas. What we see here is that while general monetary policy shocks are a driver of housing price variance, ranging between 10–12% of explaining the variance of housing prices, unconventional monetary policy shocks are the main drivers of housing prices after 2010, seeing an explanatory power of the variance of housing prices of 40 to even sometimes nearly 60%. Not only unconventional monetary policy shocks have a stronger effect on housing prices, but they seem to be the main driver of housing prices after 2010. So, in conclusion, the impact of monetary policy is unequal across segments, regions, and policies. Prices respond stronger and more persistently than rents. Both are more affected in rural than in urban regions. And unconventional monetary policy induces stronger responses than general monetary policy, driven especially by stronger responses in urban house prices. In this paper, we go a bit into possible regions, we theoretize a bit about them, and we talk about who is most affected, but some further comments and further research would be interesting to know the distribution of consequences, because renters are normally poorer than owners, and there are more people in cities than in rural regions. So does this have a distribution of consequences? We would like also to hear your comments about that. Thank you very much. Yes.
It was actually preceded by the housing shock, and then kind of monetary policy was corrected. So it's not really, so it's also kind of, you can say that monetary policy can be sometimes a reaction on houses, house price troubles in some way. So actually the crisis may affect, so the relationship may be different depending whether there was just a housing boom before or not. Do you do this kind of differentiation between the type, what happened before monetary policy shock?
So you mean that because the house prices had already gone so much up that after monetary policy shock they were able to go down so much again?
And it may depend. Not every shock is preceded by housing troubles, but these two were preceded by tremendous increases in house prices. So I think there must be different reactions because of that.
The thing is, for example, we take our sample for unconventional monetary policy after 2010, and if we look at if we look, for example, at the data on housing prices over time, which I don't know if I'm able to show, after 2010 there's still a very strong increase in the housing prices until 2021. So there isn't a peak that it then comes down to. So I wouldn't say that we have a peak in 2007 and 2000 and then the coronavirus 2021 because firstly those are outside our unconventional monetary policy sample, and we do see the housing prices increase between 2010 and 2020 basically unstopped. So I'm not sure. It is possible an aggregate, it's possible a reason that the level was decided, therefore the unconventional monetary policy was able to affect more, but it would be a thing to think about, definitely. Thank you.
Nice. Thank you for this very interesting presentation. I have two comments. The first one, you make a distinction between rural and urban areas. However, in general, like, what explains the difference between them? I mean, typically differences can be due to zoning regulations, differences in the elasticity of supply, or difference in institutions, home ownership or rent regimes. So these tend to be very relevant across countries, but in Germany, I would assume that most regions would more or less have similarities. So in your case, what is explaining the difference between the rural and urban areas? And the second point, perhaps like a clarification, you mentioned that there's the conventional and unconventional monetary policy, but if I understood correctly, the unconventional monetary policy would be mostly a restricted sample towards the end of the period. That is not really just an unconventional monetary policy because it's a combination of conventional and unconventional monetary policy, because when monetary policy hit the zero lower bound, then central banks had no other option but go for the unconventional monetary policy. So it's not really an identification of unconventional monetary policy, it's a mix between the two.
Yes, I start with the second comment. We do try to take into account that we're trying to measure unconventional monetary policy. When we do high frequency identification, normally for the conventional part, you take short-term interest rates, market interest rates, to measure the response to an increase in interest rates or a shock in interest rates in the monetary policy. To measure the unconventional part of the monetary policy shock, instead of using short-term rates, financial market rates, we use medium to long-term financial market rates. So we try to capture the shock in the longer-term expectation of monetary policy, which would, partly in the literature, is considered the shock to the unconventional part of the monetary policy decisions. So we do try to account this difference between conventional and unconventional after 2010 by using different market rates when identifying our monetary policy shock instrument. But there is a point to be made that we do only a restricted sample, so it is also not only this difference in unconventional and conventional, but this difference between what happened before 2010 and the last 10 years, where this housing market also exploded in prices in Germany over the last, now more 15 than 10 years. But we do take into account that there is this unconventional type which we try to explain, and we use a different market rate which has been used in the literature or the 2-year bond rate has been used in the literature to identify unconventional instead of conventional monetary policy. To the first comment about what could drive the mechanism that could drive the difference in response in urban and rural prices. In the paper we talk about a few. One of them could be population. We find that in response to monetary policy shock, there's a slight decrease in population in rural regions, and there's no change in urban regions, meaning that maybe people move into the city due to worse economic conditions from the monetary policy shock. The second reason we pose is difference in housing market liquidity and buying, selling, renting, or renting housing, which is easier in the city, more difficult in the rural region. So when there's an introduction of a monetary policy shock, which makes it more difficult for everybody, where it was easy, it becomes a little bit less easy, but still easy. But where it was difficult, it becomes more difficult. And this difference in decrease in ability to match buyer and seller, landlord and renter decreases more in rural regions than in urban regions. Therefore, they're decreasing the prices more. And the third reason, well, there's a fourth one, which is differences in ownership rate. There is a paper that talks about the size of the rental market being a buffer for monetary policy shocks, decreasing how strong they are transmitted into the housing market. So big cities or regions with big cities normally have higher bigger rental markets, which is basically a buffer for monetary policy shocks, which would also explain this difference. And lastly is the deposit channel, which was shown by Drexler et al. 7-8 years ago, which is the idea that in response to monetary policy shock, regions or banks that have more market power are able to increase the spread between the rates they offer deposits at and rates they take deposits in and rates they loan their money. So by increasing the spread, more people, as their rates anywhere else are high due to monetary policy shocks, people will take out deposits and move them into bonds or other assets. And due to that, because this increase in the deposit spread is bigger in regions where banks have more market power, more deposits will flow out of these regions. And as banks need deposits in order to finance their loans, and regions where they have more market power increase the spread more and more deposits flowed out of these regions or out of these banks, they're able to lend less. And including lending will include mortgage lending, which will therefore decrease demand or possible demand for home ownership. And that will, because banks in rural regions have more market power than in urban regions, this should happen stronger in rural than in urban regions. In the paper, we don't prove any of this, but these are reasons we found in the literature which seem plausible to why we find the results we find. There are differences, for example, in the real estate transfer tax, which we, in some sensitivity analysis, we also include in our estimations and makes no difference in the results. In zoning regulations, I don't know right on top of the head. There are arguments to be made, for example, that in bigger cities than in smaller, or bigger regions than in smaller regions, the housing supply is more constrained. So therefore, prices should shift more in the regions where the housing supply is constrained. But we take a look at housing supply at these regional differences in the maximum response to monetary policy of housing supply. And the difference between regions is not as big as one would expect. So therefore, they don't seem to have an effect. Or at least the effects of the other channels we say that could be will have a stronger and more important effect in Germany than other channels that may confound the results. And thank you very much for your comments and for your attention. I appreciate them.
Before we start with the next two presentations delivered by Matthias, we have to make a little technical break because of some problems that there is no sound transmission to the online participants. So they don't hear us and they cannot say probably anything. So just, but if you wish, you can go there, but we'll start, I don't know, in 2 or 3 minutes maybe. Good ideas. Takes some damage.
Questi diciamo la segreteria. Non gli arriva niente. Stacca e riattacca cucina, cultura, giusto? Vedi che arriva, poi inizio
Ma avevate fatto una prova?
Quindi, dove siamo arrivati? Che adesso arriva e poi si canta, però non abbiamo interpretato nessuno.
L'audio gli arriva e poi smette di arrivare a un certo punto.
Io posso provare a riavviare anche